Welcome back to sophomores, juniors, seniors. Welcome to our freshmen. I'm Dr. Abella. It is my privilege to be your dean. A quick announcement before we begin, or a couple of quick announcements. First, as I think you all know, you need to register for the super curriculum series, MGT 199, 299, 399, or 499, depending on what year you're in. For some reason, 240 of you didn't, so you need to leave now. No. So we're going to try to batch register you, but if for some reason we can't, you'll be receiving an email saying, now is the time, please go and register. So we're just going to finish that off. And then for next year, we'll try to just batch register everybody, and you won't have to worry about it. Before I introduce our speaker, I'd like to introduce our new Student Experience Manager, Ms. Julie Larkin. Julie, come on up.
Hello, everyone. So I'm the new Student Experience Manager in the business school, and I'm really excited to just make your experience the best that it can possibly be here. So please don't hesitate to contact me if you need anything. I just want to talk to you about a few quick events coming up. Tonight, the Business Professional Society, they were the ones giving you the yellow papers coming in. They're hosting a LinkedIn event tonight, right after this in this room. So if you want a professional picture for LinkedIn or want to learn how to get business cards, stay for that. It's going to be a great event. They're a great society. There's also Trivia Tuesday coming up next Tuesday night. So all you first years, you can get orientation extended credit for that on the yellow line, which is really fun. You'll see some of the professors there. We'll ask embarrassing questions. It'll be really fun. So please come. That's next Tuesday, September 16th at 7 o'clock in the food court. There are also study abroad flyers. They're blue papers that you can pick up on your way out. If you're interested in studying abroad in Rome with a business school, you can learn more info there. And so now I just want to talk to you about the super curriculum. So look around you. You're here now, okay? This is the super curriculum lecture portion of the super curriculum. So every month we'll have great speakers come in to talk to you and really get a chance to open your eyes to what we can do after graduation and what are we doing studying business here at CUA. So that's mandatory as part of your management series, as Dr. Bella mentioned, Management 199, 299, 399, and 499 based on your year. And that's the lecture portion. If you cannot make one, please email me. You guys have been great about that. Keep that up, and we can remove the hold on your account after you make up the makeup work, okay? But we'd really love to see you at each one. So now I'd like to introduce Miss Mary Kate Kelly, and she's going to talk to you about the career development portion of the whole super curriculum.
Hello, everyone. If you don't know me, I am your Corporate Relations Manager, Miss Kelly, and I'm in charge of the career development portion of the super curriculum. So as you guys walked in, each of you should have a yellow packet in front of you. The right-hand side's the career development portion of it. And as you can see on it, we changed a couple of things this semester in regards to career development, hopefully for the better, and hopefully it manages with your schedules a bit better this year. So please read this packet carefully and complete all of the requirements under your specific grade level. So the point of me being up here, I would like to introduce to you guys a couple new people who are working with me on the career development side. It's your career development team. And I want to introduce them as we briefly touch on your requirements. So for freshmen, it's really simple for you guys. You attend one session on November 4th. You complete your career development requirement. That session's with me, so I look forward to meeting each of you during that time. Sophomores, juniors, and seniors, this year is a little bit different. We want you guys to have the option to choose which 2 modules you would like to attend for your career development requirement. The list of modules is on the back of the first page in your packet. There's 5 of them this semester. There'll be 5 of them next semester. If you choose 2 of these and go to them, great, your requirement is fulfilled, but you're open to go to as many as you would like. The person who would be teaching these modules this semester is your new career coach, Hira Fernando. She is right over here. If you'd like to stand. You can call her Hira, H-I-R-A. She comes from a great background. She has her own company in career development, working with business professionals and with students. Pick her brain, get to know her. She's going to be a great asset to each of you this year. Seniors, in addition to the modules, you'll also have the option for one-on-one career coaching. Actually, the requirement for one-on-one career coaching. So I would like to introduce you to Heather Kinney. This is Heather here. Both Heather and Hira support the students at Georgetown University. Heather specifically with the undergraduates. Hira has worked a lot with the MBA students there. So seniors, as you can see on your packet, you are required to meet with at least one of them this fall semester. So when you get the email from me on how to sign up as soon as possible. So this leads me to our final team member in career development. It's Therese Desolitz. She's right here. She is the program coordinator and will be organizing and running all of the career development related events for you this year. And she's the one who's been sending you emails weekly since you started in regards to internships, jobs, and all of the events and programs that we're going to be offering you guys this semester. So keep an eye out. The back page in that packet is a list of 3 networking panel events. Seniors, you will actually receive you will actually be able to fulfill your career development requirement by going to these networking panels. I heard your feedback last year, I'm responding, so hopefully this will prove successful for you guys in meeting employers. So if you have any questions, feel free to email me. My email's on the paper, or see me after the lecture today. I'd be happy to answer your questions. And this is Dr. Abella and our speaker. Thank you.
Thanks, MK. One last thing on the topic of feedback. Last year we created the Dean Student Advisory Council, and this is a group of students spanning all 4 years and graduates, and your job is to give us feedback on ways to make the school better. This last year we took anybody who wanted to be a member. This year we're upping the ante a little bit, and you have to apply. And so if you're interested in applying, the obligations of the council member are to meet once a semester with me and share your feedback. So it's not a very high bar, 1 hour per semester, so 2 meetings. And if you're interested, this is the application form. It's a red form with 2 questions on it. Ms. Larkin has the forms. So after the event is over tonight, you can go and ask her for a form if you're interested. We're looking for representation across all years and all majors. And we're just asking you to express your interest by applying using this. It's also something you can write on your resume, member of the Dean Student Advisory Council. It sounds very impressive. And it is. Now I'd like to introduce our first supercurriculum speaker for this year. Michael Millette is the global head of the structured finance business in the finance group of Goldman Sachs. He's also co-chairman of the Structured Finance Capital Committee, serves on the Investment Banking Division Client and Business Standards Committee. Michael joined Goldman Sachs in 1994 in fixed income, moved to the finance group in 1997. He was named managing director in 2002 and partner in 2006. Prior to joining the firm, Michael worked as an analyst at Citibank and a portfolio manager at John Hancock. Michael serves on the board of visitors for our School of Business and Economics. He's also on the board of trustees of the Inner City Scholarship Fund, the board of directors of the Massachusetts Boys and Girls State Foundation, the publication committee of the Manhattan Institute, the finance committee for the Ursuline School, and the advisory board of the Boston College Center for Asset Management. Michael earned an AB in history from Cornell in 1987, an MS in finance from Boston College in 1994, and became a CFO charter holder in 1994. Please join me in giving a warm COA welcome to Mr. Michael Millette.
And mics. Good, I think everyone can hear me now. And I'm glad we're doing this here. I tried to persuade Dean Abella that we could use the 3rd floor of McMahon, but it wouldn't have been a good fit, and it would have been pretty hot up there. So thank you all for coming. Thank you, President John Garvey. Thank you, Dean Abella, faculty, staff. Thank you to all the students of the School of Business and Economics who have joined tonight. And I know that I'm joined by the whole board of visitors in being excited to have the opportunity to work with you to build a school that provides a first-class education in business concepts and competencies, and that also builds that on a basis of ethics and Catholic principles. The board is something that we got together for the first time last year. We're getting together later on in September, and we're very excited to be working together with all of you. I'd like to outline my own background, some of the endeavors that I've had the opportunity to undertake, and I'd like to offer some advice that I'll urge you to take with a healthy dose of critical examination. My own education continues to be a work in progress. And I'll start out with a story. A little more than 10 years ago, one of my colleagues and I sat down with the senior management of a financial company that was facing a capital shortfall, and that was due to falling asset values. It was in the wake of the collapse of the tech bubble, which I was just talking about with one of the faculty members. There was speculation in the market that the company was soon going to suffer from regulatory intervention, and there was speculation in the press that the company could fail. And it was consequential because this was in the city that it was located, one of the 2 or 3 largest employers. So this was a real problem. And it was a problem because the regional economy that was going to really suffer as a consequence of this was the regional economy that I actually grew up in. So my colleague and I sat down with management and tried to work out a plan to reinforce their capital base. They were weak enough that we could not put together a wholesale recapitalization. We weren't going to be able to go and do a big debt and equity raise and have the company reappear on the public stage, convincingly recapitalized and free from doubt. We actually had to scrape and put together, and we worked half a day just thinking of ideas. We put together 4 things that they could do. We were going to move the corporate tree of companies around in a certain way that would free up some capital. We were going to sell off a division that we felt that there'd be some demand for. We were going to buy back some debt and buy a protection contract. And the company could do those things, and we thought they could do them by year end, and we thought that that would be just enough to get the market and the press to believe that they were going to be able to survive their trouble. And so we set about to do it. We started in October. We had to finish by year end. The company's regulators essentially reviewed the plan with us and with them and said, get this done and we'll think about what to do. And we wanted the financial statements to look appropriate at year end. It took all of December to execute the last pieces. For Christmas, I took my wife and young kids to my folks' house, and every morning during Christmas week, I commuted down to the company. We called a break at 4 p.m. on Christmas Eve, and we actually got back on a conference call at 8 p.m. Christmas night. So we gave ourselves 28 hours off for Christmas and managed to not reach agreement on the divisional sale with the other party until New Year's Eve. This was pre-BlackBerry era. So I went with my wife, we went out to eat, and we actually went to a restaurant that had a fax machine so that if there were late-breaking issues, I could get called on a cell phone and go over and read legal outtakes on the fax. And we finally signed up the deal at 10:46 at night on New Year's Eve. And I'm thankful that I'm actually decided to be a banker and not a lawyer, because they actually had to stay in the room until 10:46 at night. We announced all 4 transactions. Part of the deal was we waited and announced all 4 transactions at once. They weren't material until year end so that we could coordinate that because we were really scraping to try to put together enough to show that the company was going to remain solvent. We wanted the impact of putting all these things together. So we announced all 4 of the transactions in early January. And equity analysts reviewed what the company had done, reviewed what it looked like pro forma, and decided that this was enough, that this took the company back from the edge. And the regulators gave us a greenish-yellow light as well. But that was enough for the company to not seem to any longer be in danger of failing. Their share price went up 60% in 2 days. And the city newspaper where the company was located announced that the company was not going to collapse and that the jobs in the area were saved. And this was, just a second. This was very impactful for me personally because I grew up in Massachusetts and I had worked there, and I had moved to New York City to work at Goldman Sachs several years before. And my parents were so unhappy that my wife and I and our oldest son and our oldest daughter soon to arrive, and she's here at Catholic right now, that we were moving so far away from Massachusetts that I think in revenge my mother claimed not to know how to pronounce the name of my company, which is Goldman Sachs, for several years after I started working there. She would pronounce it Goldman's and Sachs on purpose to show like her continuing unhappiness with my decision to leave her. And this, I think, finally had an impact. This finally helped them to understand what I was hoping to do as a banker, that what I had gone to try to do as a banker in New York. My aunt, who lives in that city and runs the YWCA and has worked in nonprofits all her life, I think gave the longest block of verbal text on a sustained basis praising Wall Street that she's capable of as a consequence of this. It was thrilling, and that was what I hoped to do when I became a banker, and that's what I went to do in becoming a banker. And so let me explain a little bit more and give you some personal background. Serving as a banker at Goldman was my third job. My first job was, I went to undergraduate school at Cornell as a history major. In those days, it was easier to move from liberal arts majors into banking jobs out of undergraduate school. It's still doable, but more and more of our new hires are business majors, certainly. But I went directly into the analyst program at Citibank. I had a great 3 years as an analyst. I worked with companies on recapitalizations, on mergers, on financings. It was significant. It was impactful. It was exhausting. I worked all the time, like all the time, a lot of nights too. But it was really, really engaging work, and that's what I hoped for when I became a banker. When I was an undergraduate, it seemed to me that the value of this sort of job is that I'd get to work with different companies in different situations, and even from time to time different industries, and that would be interesting, that ongoing learning and thinking about situations would be interesting. And it's actually history is suspiciously good training for it, because you have to get into a situation and learn about it and analyze it, which is in fact what you do in a lot of history. So I enjoyed that, but I wanted to work and live in Boston. That was something that was really important to me. I wanted to be near my family. I wanted to be more active in the community there. And so after 3 years, I moved to Boston with my fiance, who had actually worked at the bank with me. I actually tell the young people who come to work at Goldman now, I say, we go through a global process to find, attractive, and smart and ethical young people. And that's a great filtering process that you should leverage. And some of them do, if only for a night. But I did for my whole married life. And so my fiance and I moved to Boston. I got a job in portfolio management at John Hancock. It was good work. I enjoyed the work, and I got to be good at it. I felt like I needed some formal training, so I, like you, went to business school. I had gone as an undergraduate at liberal arts, but I really missed the training, so I enrolled at Boston College. Little did I know with President Garvey, who was there at the time, and got a great undergraduate business school degree, a master's in finance, and I also completed the CFA program. And it was important work. I had occasional opportunities to work with the senior management of my company in order to do larger projects, and I really enjoyed those. My wife and I managed our first house. We started our family. We have 5 children now. As I said, happy to say one is here, and my broader family was delighted to have us nearby. And while I enjoyed all that, what I really found compelling about it was the chances that I had to work on strategic transactions and projects. I was more suited to those. I really felt as though I was wired to those. I felt like I was better at those, at thinking through the steps that we needed to take to get through those projects, at getting excited about them and putting in the effort, which is always on off hours when you're involved in really big projects. And I decided I was not doing the right thing. I really had to go back, and that was what I wanted to do. And so I was lucky enough to connect with a group at Goldman that found some of the, not only my broad background, but some of the specific things I had worked on really interesting. And I started there in August of 1994, so I just passed 20 years at Goldman Sachs. And it's been a compelling 20 years. I thought about saying exciting. That's not the right word. Compelling is the right word. I've had a chance to work with companies in whole industries at critical stages of growth, at stages of difficulty, and that's been dramatic and interesting. And I'm going to go through a few slides, if I can. And I'll use this clicker, I think, because I can't find the other one. Oh, there we go. So first of all, the insurance industry. Over the past 18 years, I've had a chance to work with the development of the catastrophe bond and insurance-linked securities market. And that may sound outlandish. It sounded a lot more outlandish 18 years ago. The sector grew out of the insurance and reinsurance industry's reaction to Hurricane Andrew. Hurricane Andrew hit South Florida in 1992. It caused $15.5 billion of insured losses. I think the industry's largest actual claims payment before that time was about $1 billion. So this was the largest event by 15 times. The industry completely didn't understand how much risk it had taken on. 11 companies went bankrupt, and the insurance system was in substantial disarray. And the intellectual idea, and this was actually an academic idea as much as it was a Wall Street idea. Richard Sandor, Ken Fruit at Harvard, a whole collection of professors at Wharton, Howard Conrother, and others at Wharton, all were very interested in the notion that what we should do is take catastrophe risk and package it into securities. And then those securities would carry the risk and return attributes of catastrophe risk, which are often fine. You often are well compensated for catastrophe risk, except that if you suffer the catastrophe, it can make you insolvent. So what we should do is take those risk and return attributes, package them into securities, and then spread them out broadly into the capital markets. Because the reinsurance market at the time had about $300 billion of capital resources. And the largest, and this is backward looking. If we look back through the past 200 years, the past 100 years for hurricanes and the past 200 years for earthquakes, because we don't really know what hurricanes happened in the 19th century. You can see that we can have some pretty big events. You know, if you restate them in current dollars to reflect current exposures. You know, Andrew was over $15 billion in 1992. And if Andrew hit again, it would be something more like $50 billion because there's been 20 years of inflation, 22 years of inflation. There's also been a very substantial buildup in southern Dade County since then. But if you go further back, Andrew's not even the big one. The big one was 1926, the Great Miami Hurricane, a very strong Cat 4 hurricane that landfell Miami. Andrew didn't landfall Miami. Andrew landfell 35 miles south. The Great Miami hit like dead on South Beach, went right across town. That would have really flattened a lot of real estate in Miami and Fort Lauderdale. That would have been, per this estimate, about $135 billion loss event. Reinsurance industry globally had about $300 billion of capital resources. That just wasn't enough. So the idea is to take that risk and spread it out, because the global capital markets are tens of trillions of dollars. The daily standard deviation of the global capital markets is over $100 billion. So the global capital markets just move around more than that day to day from normal volatility. The idea was these risks should be digestible as long as investors are getting paid enough to take the risks, which we felt that they were, and we felt that the risks were measurable. So this was interesting academic theory, and I joined a team in 1996. We actually completed the first deal at year-end 1996, the first broadly distributed catastrophe bond, and we actually spent a lot of time not only with finance academics, but with with geologists and meteorologists. We spent half a day in Lamont Doherty Observatory of Columbia University with earthquake scientists going through to make sure that the modelers that we were listening to were actually faithfully representing the best academic theories about earthquakes. So we spent a lot of time doing this, completed the first deal. Since then, I've had the chance to, I eventually took over leadership of that group, and we've completed more than 150 different transactions that have created capital for the industry. And that includes a variety of transactions. I got to go to Turkey and advise the government on recreation of their earthquake insurance system after the 1999 earthquake at the behest of the World Bank. I worked with, after 9/11, the city of New York to form a new workers' compensation system, and also a group of insurance companies to form a new terrorism insurance system. Worked on the development of a new type of capital instrument called the reinsurance sidecar after Hurricane Katrina. You can see Katrina was a terrible event, but you know, Andrew would have caused more loss than the big one. The really big ones back here, which maybe some of you are wondering about, you know, $200 billion loss events. Those are large earthquakes that occurred early in the 1800s in Missouri. I don't know if people are from near Cape Girardeau or New Madrid, but there were some monstrous earthquakes there that hopefully will not reoccur for another 500 years or so because they are destructive. But worked with Aetna to develop new ways to securitize and protect themselves against health risk around the time of the passage of the Affordable Care Act, and then actually worked with the United Mexican States, or the Republic of Mexico, the UMS, United Mexican States. Mexico was doing, was trying to get a type of coverage that we actually worked to develop called parametric coverage. Mexico, like many developing countries, has an insurance system that is still developing. And because of that, when there is a major event, the government finds itself in charge of remedying a lot of the loss. And the government wanted to form an emergency fund that would come into its hands quickly. Insurance doesn't come into your hands quickly, because when there's an event, you have to figure out how much you lost, and you negotiate with the insurance company, and there's a lot of back and forth. And Lord knows Mexico didn't feel like their claims adjustment systems were well enough developed. So what we did with Mexico is we and Swiss Re worked together. You can see the Mexican earthquake zones. These are latitude and longitudinally defined boxes around certain parts of Mexico. And if there are triggers which are earthquakes of certain magnitudes in zone 1, which is here, 7.9 magnitude, 8.1 in zone 2, and so on. If earthquakes of certain magnitudes occur, the United Mexican States will get a payment from the bond issuance, and the investors will not be repaid. That's the risk they're taking. The investors are paid a rate that is higher than the probability that such events will occur, and that's why they do it. And you can see we developed zones around Atlantic hurricane and Pacific hurricanes as well. So that's been an interesting sector to develop. The total sector now is past $60 billion. We have been a leader in the sector and continue to lead the sector, but other banks, of course, participate as well, and sometimes we work with them. That's been That's been an enormous project in my career at Goldman. Another challenge was the development of our transport finance business. For some reason, we never had a great transport finance business historically, and in the pre-crisis period, we began to see a need to develop one. In particular, aviation. Global aviation traffic was increasing. Airline traffic increases at an exaggerated rate versus global GDP. You can see that here. When global GDP is increasing, aviation traffic increases faster. And you can imagine, and we felt that was true, and that was going to be especially true for the foreseeable future because of the growth of developing markets. Because in developing markets, we had an enormous growing business class and middle class that was coming into the class of aircraft travelers. And we decided we had to have a really good transport finance business. And so I recruited a couple of people. I put some of our people to work. We formed a great team, which promptly got not busy because the team came together by 2007, and we were on one deal in October 2007, and after that deal, the financial crisis set in, and there was no aircraft bond issuance on Earth for 5 sequential calendar quarters. So our team was essentially shut down right out of the gates. But our analysis was that the fundamental reasons to form the team hadn't changed. And our analysis was that one other driver was going to become even more true, which it was going to become more difficult for banks to keep up with the expansion in aircraft and other transport equipment financing because of the financial crisis. So we kept our team together, and we kept our team together. And meanwhile, across the industry, a real concern developed over this period of closed markets, a concern that we were in a financing gap. Every industry conference you went to would talk about the financing gap, the inability of companies to finance their transport equipment. So our team spent the months of closed markets working with clients and investors to develop several new approaches to transport finance. We worked with the US Exim Bank, the ECGD in England, COFAS in France, and Hermes and Euler in Germany to develop export credit agency-wrapped bonds. We brought the first one to market, and more than 20 billion of those have been issued by ourselves and by other dealers since. We worked with the rating agencies and the aircraft lessors to redevelop criteria for aircraft asset-backed securities. We worked with governments and lawyers in different jurisdictions to develop some tweaks to regulation to allow a particular type of aircraft financing that's popular in the US called Enhanced Equipment Trust Certificates to be issued abroad. And we brought the first one to market for Emirates and did the largest financing ever of A380s, which are those gigantic 2-story high jets that Airbus produces. And we also worked with leveraged finance bankers to migrate some of the debt of aircraft lessors from regular way capital markets into leveraged capital markets. And that was an exciting time. It was exciting to be doing all that work. It wasn't exciting for the first 5 quarters because we were doing all that work and not getting anything done, but we thought that at some point the crisis would end. And it absolutely did. And it did, and all that work helped to do 2 things. One thing that I was very parochially proud of is that we emerged from the crisis as the leader in aircraft finance. We have, so you can see what's happened. This is what aviation finance looks like nowadays. You know, in the pre-crisis period, you would have seen a lot of banks and a little bit of other stuff. But now you can see this is, bank financing as a percentage of the total is relatively modest. You can see it's an even mix of all of these different types of bond financing. And the other thing that has happened is the whole notion of financing gap has disappeared. There was no financing gap crisis. Aircraft companies, including the carriers and the lessors, were able to finance their business. And so this was a problem that ultimately we were able to help to remedy. A more complex story is the development of residential mortgage finance over the past decade. US residential mortgage finance, or home mortgages, This was one of the most successful markets on earth. Over the course of the pre-crisis period, actually over the course of the past century, we've developed residential mortgage markets in the United States that are capable of financing $1 trillion or more of residential mortgages every year. We do this both through securitization markets and through the government-sponsored enterprises, Ginnie Mae, Fannie Mae, and Freddie Mac. It's important to consider what a huge project and how beneficial this is in light of the crisis that we had in it. Everybody in this room, and to understand the subprime crisis, you have to understand one key factor. Everybody in this room, including every student, or maybe almost every student, has a credit rating. You all have a credit rating. It's called your FICO score. They look suspiciously like SATs. In fact, just as you're leaving the SAT era of your life, you come into the FICO era. I think for most people, their FICO scores will tend to be slightly lower. So the prime boundary, the boundary for prime FICO scores is 680. So hopefully many of you and your parents have FICO scores of 680 or above. And the boundary, and people that are not at 680, which includes most Americans actually, not by a lot, are actually mid-prime, non-prime, or subprime. So that's what that word means. And you get a FICO score. FICO doesn't stand for anything. It stands for actually Fair Isaac Company, which is the company that invented these things. But what it's really measuring is whether you pay on a timely basis, and it's measuring whether you have an appropriate amount of debt relative to your income. And FICO scores in the subprime crisis. You know, in the days, if you go back 15, 20 years, if you had a prime FICO score, you could get a 30-year residential mortgage. If you didn't have a prime FICO score, you would have much more trouble getting a mortgage, and your rate would be much higher, several percent higher, several hundred basis points higher. So less availability, tougher terms, a lot higher price. And you know, what happened over time, over really the 80s and 90s, is that government officials, investors, and consumer advocates all noticed something, which is that for several decades, for the 60s, 70s, 80s, 90s, people with subprime mortgages had only slightly higher default rates and slightly higher loss rates than prime mortgages. But they were much harder to get, and they were much more expensive. For investors, that seemed like a profit opportunity. For government officials, that seemed like a chance, like a way to expand home ownership on a bipartisan basis. This was completely bipartisan. And for consumer advocates, it seemed unjust that subprime borrowers had to pay so much more than prime borrowers. And there's not much that is more powerful in markets than when you have justice and policy and profit all marching together. And you can see that here. So in the old days, 1999 and before, subprime mortgages, and in the new days like now, subprime mortgages were produced at a rate of about $100 billion a year, out of $1 trillion of new mortgage production a year. From 1999 to 2005, the dark blue piece of each of these bars shows non-agency mortgage production, meaning non-Ginnie Mae, Fannie Mae, Freddie Mac, and this is mostly subprime. The light blue is home equity loans, manufactured housing, and other related housing debt. So that total was less than $200 billion in 1999 and even less in 2000. That sort of financing was running at a rate of over $1 trillion a year by 2005, 2006, and into the first half of 2007. You know, and you can imagine that as that sort of lending expanded, the nature of the people borrowing and the nature of the loans was shifting. And in fact, it was shifting, first of all, the nature of the loans was shifting in a way that we couldn't possibly expect these loans to behave the same as these loans. But also, this financing was driving an enormous asset price bubble in the economy. And that collapsed with really horrific impact financial institutions, on markets, and on people in 2008. And that was the genesis of the subprime crisis. And you know, we see a lot of accounts of it. We see a lot of accounts of misdeeds of banks and misdeeds of mortgage originators and misdeeds of homeowners who borrowed too much. But, you know, and there's a lot of blame to go around. But, you know, really at the very base of this, the problem is the asset prices and a misunderstanding. If we look back at all those decades when subprime homeowners were performing well, you know, part of it was that they were carefully selected, but part of it was we had several decades in the US where housing prices on average just went up nationally. So if people couldn't pay their mortgages, they sold their house. They didn't default because usually their house was worth a little bit more than it was when they bought it. They could sell their house, repay the mortgage, and move on, usually with good grace. Sometimes they could get back into the mortgage system later on. And there wasn't enough reflection on this. You know, part of the reason I point this out is at some level good statistics itself is an ethical issue. Because if people had thought more carefully about what was going on, we wouldn't have had this, and then we wouldn't have had this, because you can see the impact. This is securitization markets in the US, which are primarily consumer finance, and you can see the collapse from 1.7 trillion to 170. There was actually a 90% decline from 2006 to 2009. And most of that is financing that is available to consumers to buy housing and cars and make credit card purchases. So, you know, that was not just a financial construct, that was tragic. I hadn't done a lot of work in consumer finance before the crisis. And afterwards, I was asked to work with our team. Afterwards, the businesses in my company that had done that came into my group. And I had to work with the teams to rebuild these businesses in a way that made sense. So I worked with teams to take the lessons of the crisis into account. This has been engaging. It's not always pleasant or easy. We were used as an example for all of Wall Street for one transaction that we did. That was painful. We've thought a lot about the implications of that transaction, of the crisis, and structuring and documenting and disclosing deals. We've worked to rebuild our warehouse lines. I've worked with my teams to rebuild those teams and to try to make sure that they are thought leaders and to try to reestablish ourselves in the market, and that's a continuing project. And that's also compelling. You can imagine that exciting is not the word to describe that. But that gets back to the notion at the beginning of my whole talk, what I had gone to Goldman to do. I certainly hoped that working in Wall Street and in banking would provide me with a way to support my family. Actually, initially, when I went from Hancock to Goldman, I took a pay cut. And it was worse than that, because New York is a lot more expensive to live in Boston. If those of you who are making that choice, just that should be clear. New York's expensive. And so for a couple of years, I was working all the time. My wife was home because we had two very young kids. We didn't know many people. It wasn't the best of all moves. But I really felt like I had to move on. And the fundamental reason is I didn't feel as though in Boston I was on the path to my own highest and best use and career. I miss the process of working with companies to sort out their choices and to execute their choices. There's some trade-off between career satisfaction and lifestyle. Bankers don't lead the best ordered lives. All of the projects that we do don't always fit into a 9-to-5 day. Thank goodness my wife was originally a banker because she understood that and always supported what I was doing. But I finally found a coherent way to explain why I wanted to go back to that at a presentation. I had to do a presentation at Yale to MBAs a couple of years ago, and it wasn't because I went to Yale. All the right executives were like traveling, so I was sent up to New Haven. And I had some prepared remarks, but I was very distracted by our recruiting video, and I talked about that instead. And there were two reasons I was distracted. First of all, it finally struck me, and Instagram has brought this home to me even more, that all that stands between many of us and greatness is better lighting. Like people that I work with every day just looked great in this recruiting video because they had such good lighting. And you know, so I've become a big fan of filters. Like I just look so much better, and not with Valencia or XX Pro, but I actually prefer Brannon because I'm a little older. But the lighting was great. But the other thing that was great was this one young woman that I work with said the most amazing thing. She said, the reason that I like being a banker is that I get the chance to work with companies at the most important times in their lives. And I thought a lot about that. It's just kind of it's a simple notion, but it's exactly right. What each of us does in our vocation is we have capabilities that we put at the service of others. And most people's vocations involve doing similar things every day, and there's a quiet dignity in that. But if you have great capabilities, you should be putting those at the service of others at times that are really important to them. And the great privilege and responsibility of finance careers is the impact and leverage that we gain. We have the opportunity to work with companies and industries when they're growing, or when they're changing, or when they're shedding businesses, or when they're in trouble. And that is really engaging, and it's really responsible. It's really thrilling to work on a deal that goes well, and not just because you think you're going to make a bigger bonus at the end of the year because people are going to know about that deal. It's just inherently thrilling to use your capabilities and do something that is really important to a lot of people, not just the other people, not just the executive management, but maybe to a lot of workers, to do that well. And it's really horrifying to screw up. You know, if you don't think through issues and you manage to create a merger, sponsor a merger that ultimately leads to lots of layoffs, you're culpable in that. You're complicit. So it's a responsible position. So let me propose that this is where business ethics, at least for me, starts. A position where you can earn a lot of money and impact people's lives entails a great deal of responsibility. I hear people say they enjoy jobs like mine because they enjoy the challenges. And I think that's trite. The deep satisfaction in jobs like this is if you are exercising a vocation. I'm always happy to have my work recognized through compensation, but that doesn't drive the way I seek to do work for clients. I want them to succeed. I want to be capable of helping them to do that. I'm happiest when it's clear to me that I've done that. No matter how well we impress those around us, we need to judge our own vocations, and that's a lonely process in the end. And preparing for this talk has led me to think through deals that I'm working on, and I've actually gone back and readdressed issues. I have one more idea to propose on vocation. Each of us knows what we're capable of contributing, and it's our responsibility to develop those capabilities. Vocations pick us. We don't pick them. So settling into a career where you know you're capable of more is leaving something socially on the table. So now we come to the advice part of the speech, and then one quick story. So some advice. Many young people I see coming out of school today seem to have divided their lives into compartments. They will focus on a career now, and in truth, part of a career. In many cases, I hear people being advised to do this. I met with, we had a meeting, actually lead recruiting for Cornell and BC, my graduate and undergraduate schools for investment banking. We met with a bunch of career office leaders for different universities, and I talked with Harvard's. And she told me 40% of Harvard students were going into investment banking analyst programs and Teach for America. So that meant that 40% of Harvard's students just wanted a 2-year job. And it occurred to me that in some cases they want to do those things, and in a lot of cases they want to play forward safely. And there's a lot of that, and we seem to be adapting into this paradigm of people taking on a series of time-limited jobs. Go to work for 2 years in Teach for America, and then go to work 2 years somewhere else, and then go to business school, or go work 2 years in a bank, and then go to work 2 years in private equity, and then go to business school, and then go do something else. And that can be really valuable if you think that that's what you want to do. But I think that a lot of people do it because they don't know what they want to do. And I think that that is problematic, because I think that going through those processes is very taxing and very distracting. And you can't devote a lot of discernment to what you would really like to do when you're competing madly to get through those sorts of processes. So I think that this is problematic, that we have so much effort now absorbed in this 22 to 30-year-old steeplechase that we're developing around young professional careers, and not a tremendous amount of discernment. And my example of that is, I can't tell you, this is a little bit of a warning, I can't tell you how many bankers and lawyers in their 40s that I talk to that joke about what they want to do when they grow up. Good grief. Like, these people are supposed to be talented professionals. What were they supposed to be doing all along? Meanwhile, if they're not in a vocation, these are responsible careers. You've got to feel very devoted to them. The notion that you're cruising through and you don't feel a tremendous amount of investment in that career, to me, is problematic. And the second thing to keep in mind is that while society may be moving to an extended period of career development, our humanity has its own imperatives. It used to be the case that the 5 key tasks for people in their 20s were to establish a household, complete school, form a career, get married, and start a family. And you can do 4 of those whenever, but starting a family is kind of time limited. You have to do that by the time you're in your 30s. So having this whole system where you're going to go through a whole series of 2-year jobs and then more graduate education, that's going to stretch clear into your 30s. You need to design your entire life, and that includes designing a personal life. And I see people that try to get through their career life with the notion that they're going to develop a personal life later. And there are 2 problems with that. One of them is biology, and the other one is, by then you've gotten kind of strange. So that's the advice. One more story before winding up. One of the regrettable things about becoming a more senior banker and manager is that your job evolves from working on a handful of deals closely with clients to participating in a more fleeting way in everybody's projects. I have about 70 bankers that work for me, and I work on all their deals. And it turns out that when their deals are going well, they seldom need me. They need me when their deals are going poorly. So I end up being the cleaner. And I like to, and so there's just this series of issues all through the day. And in my lighter moments, I like to think that I'm recreating Mr. Wolfe from Pulp Fiction. I actually worked with the Weinsteins to start their new studio. I told Bob Weinstein that every banker wants to be Mr. Wolfe. You remember Harvey Keitel, and all of you have seen Pulp Fiction. But I'm afraid that I'm just not that crisp and that self-assured. So a couple of summers ago, I got to fix this because it was August and because there was not a lot going on. And I got a call one Monday night from an old colleague that was also a friend that I had worked with, and it's a great guy, and he was at a private equity firm, and he and another private equity firm owned an insurance company. And he called me on Monday night because they had just been told by the company that they were going to get effectively a catastrophic downgrade the following Monday morning after meeting with their rating agency, and they didn't know why. And they wanted us to figure out why and figure out how to fix it. And so that led the next day to me pulling together a team, everybody I could find who wasn't on vacation, and digging into the situation. And we spent the next day working with management, trying to understand how they got to this place. And this is where my history major was really helpful. I was talking about this with President Garvey. When you talk to different managers of the company, every account was different. It reflected all of the virtuous things that particular manager brought to bear, and then other misdeeds that had gone on elsewhere. It took us about a day to try to determine what had gone on, why the agency was frustrated, what we had to do to try to get this company in shape so that they wouldn't take this downgrade, which would have effectively put them out of business. We launched a two-tiered process. We brought several investors under confidentiality and signed them up for a Thursday roadshow. We prepared, the team put together term sheets, and another part of the team put together a data room so that they could study the company. Separately, we launched 2 bilateral processes with reinsurers, where we were going to try to negotiate a deal with each of them. So we had 3 different processes going on at once, because by now it was Wednesday morning, and we knew how much money we had to raise, but we didn't know who we were going to raise it from, and it had to be done by Monday. By Friday afternoon, we were at an in-principle deal with one of the companies. We were at an in-principle deal with one of the reinsurers that we felt would work. The only problem was, by then our credit analyst had talked to the agency and determined that part of the problem was the company had presented plans before and then hadn't followed through. So the credit analyst felt that before the company walked in on Monday, we had to close the deal. And I don't know how many of you have worked. The difference between having an agreement in principle and closing a deal is a big deal. You have to have all the legal documents done, and you have to have funds actually flowing. So that set up our weekend. I had guests. My wife and I had guests. So I carved out specific blocks of time to spend with my family and my guests. And then I essentially worked all weekend, including the nights. We got through the legal documents. Sunday night, the general counsel of the reinsurer was actually involved in a series of flight delays. He was at airports and working off his tablet. So he was flying, and I'd sleep for about an hour or two, get up, and then we'd do more. And by 5 a.m., we signed the deal. At 9 a.m., the company went into the rating agency. And at 10 a.m., and they were clutching a done deal in hand. And at 10 a.m., they were affirmed. The deal was private and was not advertised because the downgrade never occurred. This is really our best job, to make problems not happen. We simply solved a problem that had never been given a chance to appear. The team went on to complete a much more patient and careful restructuring and sale of the company. Our clients, the private equity firms that own the company, were delighted, and they'll do more with us over time. A few weeks later, I had a chance to catch up with John Whitehead, the former co-CEO of Goldman Sachs, in an event. John was a brilliant CEO who authored our business principles, and he was a successful Undersecretary of State afterwards. At 94, he continues to play an important role in New York City, leading the redevelopment of the World Trade Center. He asked what I was working on, and I told him the story that I just told you. Afterwards, he looked at me silently for a moment and then said, "You are so lucky." After a whole lifetime of honor and title, John still felt the draw of getting a deal done, not because of profit or recognition, but because that's what we're supposed to do. Thank you.